Hello and welcome to the programme, the latest in a series of programmes in which we speak to managers of Baillie Gifford Investment Trust. My name is Gavin Lumsden. I'm from Citywire. Today I'm talking to James Dow, co-manager of Scottish American Investment Company, or Saints, which has consistently grown shareholders' dividends for 50 years. James, good afternoon. You're in Baillie Gifford's office in Edinburgh.
Yes, I am. Yes, ready to go. And good afternoon, everyone. Thanks for joining.
Yeah, exactly. It's very good to have everyone with us, isn't it? Well, let me start then with the questions. I mean, as expected, interest rates have started to fall, but the US this month went for a surprisingly big 0.5% cut, with the possibility of more to come. What impact is this having, James, on equity income stocks and your investment approach?
I would say, Gavin, it's having a selective impact, a good impact in a couple of ways. But at the broader portfolio level, not a huge impact, not so much. So let me explain that. Selectively, one of the best parts of it, I think, or most exciting parts, is that we've had an opportunity to invest in something we've looked at for a long time, and a chance has come up. So in the US, you may know this, pretty much all the volumes of interest rate futures and other derivatives that are traded through one company. It has a fantastic dominant position. It's a company called CME Group. So it's a great business. It's grown really well over time, pays a good dividend. In the past year or so, because of that expectation of the Fed cutting rates, a story has emerged that, the lower rate is bad for CME. Completely wrong, not true at all, misunderstanding of the business model, but it's led to an opportunity to us to invest in the shares for the first time just in the past couple of months. So that's a sort of selective impact where the Fed rate cut has actually impacted the portfolio, and we're hopeful of good returns out of that for many years to come. At the broader portfolio level, I would say not so much of an impact, because if you think about what Saints is trying to do, our kind of main objective for shareholders is to grow their income and their capital at an attractive rate over a 5 or 10 year period in a really sort of resilient, high quality way. And so we don't tend to invest in shares which are very sensitive to macroeconomic fluctuations. So the fact that the Fed is cutting rates by 50 bips for our holding in Apple, let's say, that's not really going to make much difference to Apple on a 5 or 10 year view and the growth it delivers. So that's why I say at that portfolio level, not so much. Selectively, there have been a few cases where opportunities, or it's been quite positive for shares in the portfolio.
Okay, thank you. Yeah, it's interesting about CME Group. What about elsewhere in the portfolio? I mean, it's predominantly equity income portfolio, but what impact is the rate cut or the rate cuts having on the other asset classes that you hold or the trust holds? I'm thinking commercial property, emerging market bonds, infrastructure, but those parts.
Yeah, so we've got a little bit in those asset classes. They're a bit more positive. They do tend to be a bit more rate sensitive. So, so an example would be within the sort of little infrastructure group of companies we've got a holding in a company called Exelon. That is a grid company, just transmission and distribution cables in a few states in the US. And that the shares there tend to be a bit more sensitive to rate movements, and that's been positive for that company in the past 6 months or so. And for the commercial properties, again, it's generally supportive of valuations to have lower rates. But I'd also say, remember, again, the nature of what Saints invests in. So let's take the commercial property, long index linked or inflation linked, good lease life and so forth. Rates rising didn't really have much of an impact on those property valuations on the way up, and it's probably not going to be a huge tailwind on the way down. So again, at the margin, positive benefit, but not a profound difference, I'd say.
Okay, you've mentioned the opportunity in CME Group, but can you talk about your any other latest transactions and where you're finding opportunities?
Sure. I've just come back from 2 weeks in the USA in the States. 25 or 30 different companies I think I saw over that time, and in a real range of different areas, niche engineering businesses, insurance brokers, human relations, HR companies. So lots of different potential investments that could fit that Saints mindset of really good, solid income and capital growth, underpinned by earnings growth on a 5 to 10 year view. I'd say the HR, the human resources space, is quite an interesting one at the moment. So what I'm talking about here is companies that help with, payroll, talent management, in the modern workplace, managing workers. That's a really fragmented industry at the moment. But what's happening, particularly with software coming into the market, is consolidating into a number of clear winners. And so finding and backing those winners who could really hoover up market share on a 10-year view is a really interesting place to look, I think, at the moment. So I was meeting several of those companies while I was out there checking those. You might laugh, I'm kind of a bit old-fashioned on this because I know technically people say, well, you just do a Zoom call with them. And I'm always like, well, if you're going to invest in the shares for the next 10 years, you want to go and walk through the front door, right? And go and have a poke around and see what it's really like. So I've been doing all that kind of stuff and opportunities from a wide range of areas. In terms of you mentioned transactions at the start, Gavin. In terms of transactions, we run a pretty low turnover approach. We don't churn the portfolio and hold things for the long term. So this year, besides CME Group, the only other new buy that we've made in the equity portfolio is Epiroc, which is a drilling specialist. It has a really strong position in supplying drilling equipment, particularly in the mining industry. That's the only other one we've done. But there's lots of opportunities out there, and we're always alert to those from all ranges, all kinds of places.
Looking at the top 10, you've still got a large position in Novo Nordisk, which is obviously doing very well out of a sort of anti-obesity drugs. What makes you still optimistic about the future for the company after its strong run?
Yeah. Well, again, we're always looking at these kind of decades-long growth runways and saying, can we hold this and it continue to compound at an attractive rate for a long time, earnings and dividends? And in Novo's case, so let me frame it this way. They've got the insulin business, the diabetes business, that is sort of the core of the company. That continues to be in that long runway for growth category because, unfortunately, an increasing number of people are living with diabetes globally, and an increasing number of those are being diagnosed as diabetic. And so that part of their business, where they're a leader, will almost certainly continue to grow for the next 10 years. And then you mentioned it, the appetite suppressants for patients with obesity. A good way to frame this is today, Novo Nordisk is supplying about 1 million patients globally with its Wegovy medicine. The patient pool globally is estimated, people who would seriously benefit from taking it, is probably somewhere around 800 million. And they're only doing 1 million today, right? The barrier to growth in Novo Nordisk is really the manufacturing capacity of those drugs. They're actually quite complex molecules to manufacture and to bring that online. So on Novo's current plans, they're thinking 10 years out, they might be able to get supply up to maybe 50 to 100 million patients. So compared with 1 million today, so 50 to 100x. And so it's that really which underpins that thinking that, yes, the shares have done well and the earnings have grown, but if you look out for the next 10 years, is there still a lot more to go for? I think unequivocally, the answer there is yes, one of only a couple of companies that can really do that.
Okay, that sounds like there's a lot more to go for there. Absolutely. What about the AI, artificial intelligence, and the AI rush? I know from your recent half-year results that you were, expressing skepticism about the sort of potential bubble around Nvidia. But are you worried about missing out on the AI rush?
Not worried about missing out. No, we've got a number of companies in the portfolio which are clearly benefiting from that already. TSMC is quite a large position, and obviously they manufacture all of Nvidia's chips. Microsoft clearly front and center of what's going on in Gen AI and investments in that space and bringing it through, and other holdings within the portfolio. So definitely not thinking we miss out. Now, my point is more, if anything, it's thinking about how much capital and not putting too much capital into the area. My point is that at the moment, it's a very hot area. People are very excited about it and are extrapolating it, seems to me, almost in a straight line upwards. And if we look back at the history of technological innovations, they don't tend to go up in a straight line. There tend to be setbacks along the way. And it's quite difficult often to identify who the winners are sort of early on in the process. That only emerges after a period of time. And so I think ultimately it's a question of balance within our portfolio. We definitely have exposure to it. We think it's a long-run theme and it's exciting, but we want to make sure that we don't invest, bet the farm or everything is AI. And then, a few years' time, we're sort of licking our wounds because, of course, it's turned out it wasn't a straight path to travel. That's my point there. Just being careful with the balance in the portfolio. We certainly won't be missing out.
Okay, because I suppose, do you have long memories, distant memories of the dot-com bubble at the beginning of this century?
Yeah, there's a lot of it. It's sort of classic hype cycle stuff, right? It's like in the early days, people extrapolate and they say, oh, think what blockchain can do. Think what factory automation can do. Think what the internet can do. And all of those things are correct in the long run, but they do take quite a long time to play out. It's not immediately obvious who you should back, not in the early days. And you just want to be a little bit careful before you push all your chips in on red. Oh, I'm going to, bet on blockchain or whatever. Just be a little bit more selective and careful about that, and make sure you're backing a real franchise that's enduring. There are some kind of echoes of that. We've, those of us along in the tooth have seen it before, kind of thing.
Absolutely. Turning to another notable market trend, although a very recent one. A lot of investors have been shying away from China, but until last week, because investors had become very negative, but in response to a whole range of stimulus measures by the authorities, the market has shot up about 27% from what I can see. So, are you finding any opportunities there?
Well, we have continued to invest in those opportunities there through the ups and downs of that. So of our roughly 60 equity holdings in Saints, 5 of those are Chinese businesses. It comes back to that point about balance and not having too much, having some investment, but not too much. So for example, Midea, which is a leader in air conditioning equipment and other appliances in China, or Anta Sports, we've held that one for about 10 years. I think the sort of Nike of China, sports apparel, very well managed, very good brands, very well invested, good marketing support. So for us, I think for Saints, it's more about we've picked selectively some businesses which we think have a fantastic long run growth trajectory to them and are very, very strong. And so it's less about, China's going up again, let's pile back in. We added earlier in the year because some of these names were getting down to, like 8, 10, 12 times earnings multiples for 20% a year growth. So we've been continuing to hold those positions, add to them where appropriate. You're right, they've been very strong in the past week or so, up very strongly, but we're still big believers in those particular businesses.
Okay. Shares in Scottish American have been trading at a discount for a few months, around 8% below net asset value. Has the company been buying back its shares?
Yes, it has. In fact, last week, Thursday and Friday, you'll see if you look RNS stock exchange announcements on buybacks by Saints. So yes, it has. If you look back, I've looked at the charts. If you go back the past 20 years, it's actually been pretty rare for Saints to trade at a discount, and particularly these kind of levels are sort of 8, 9, 10% that it's got out to recently. And so the board is of the view, at some point, that becomes too compelling an opportunity. I think when it's like 1%, 2%, it's sort of slightly marginal, but at that sort of level of discount, the trust should be buying back shares, and it is. And personally, I'm complete agreement. I think it's just I as the manager have personally also been investing in the shares because I think when you get to these kind of discount levels, it's to me it's too extreme, it's too unusual an opportunity. So there's a clear buyback policy. The board's going for it. The manager believes in it, and so we've been buying back.
That's good to hear. Good practice because obviously it adds to it's accretive, adds a little bit to the net asset value by buying the shares cheaply, and everybody wants to get the underlying investment growth that you're generating rather than anything else.
Yeah.
Okay. Exactly. But in terms of the sort of a broad asset allocation, you've got slightly more in Europe than North America. It's about 37% to 35%. But that's a big overweight in Europe versus the benchmark index you're using, and it's a big underweight to the US. So, is all of that unusual, and what does it say about the portfolio?
I think what it says is that we're believers in that kind of balanced approach. that you can flip it another way, and you can say, well, the index is a bit unusual, isn't it? It's got 63% of its capital invested in one market and one index, and quite a concentrated one at that. And Saints, I think, we're very much pursuing a sort of bottom-up, companies balanced approach to the portfolio. Let me put it another way. Broadly speaking, you can say if you're running a trust and you're trying to generate income and growth for shareholders, there's a couple of different approaches. You can try and do that by generating an income, that sort of natural income that's generated by the underlying investments, and pay that out. So sort of naturally backed income. Or you can pay income out of capital. And they've both got their pros and cons. They've both got, you can argue them one way or the other. Saints is very much in that category of generating an income naturally backed by the income of the investments. And what that does, it makes us quite careful about the balance that we have in the portfolio. We don't want to bet 2/3 of the capital on one market and the USPE or dollar risk around the income stream. So I think when you sort of say, roughly, we're sort of a third US, third Europe, and third rest of world. And I think it's probably more saying something about Saints' approach and its balanced approach to risk.
Okay. And then just a quick one on Asia. That accounts for over 11%, which looks like another smaller overweight. But other than TSMC, the Taiwanese chip giant, which you've referred to already, what else do you hold in Asia?
A few different names. So I'll give you some examples. USS. So that's a great auctions business in Japan. Again, a bit unknown. It's not a household name, but within the market for used car auctions, there's a huge business of that in Japan. And USS is absolutely dominant in that. It's a fantastic business. Scale benefits, large moats, generates a lot of cash, lots of growth opportunities around that. So that would be one. TCI in Taiwan would be another. So they are the leader in outsourced manufacturing of nutraceuticals. So these are products where consumers are taking them not just for cosmetic benefits, but for health benefits as well. And that's a big trend within the beauty industry. And TCI is the leading sort of outsourced manufacturer of that. I mentioned Antasports and Midea earlier on. NetEase, the Chinese video game developer, again, fantastic founder-run business, very creative and entrepreneurial, committed to paying out dividends, going overseas. The point I'm making is it's really quite a broad array of quite different businesses. Some of them not particularly well known, but ones where, in our view, you've got that 5 to 10 year growth. You've got a really strong high return business model. You've got really good management. You've got the commitment to dividends, and we find those across Asia.
Okay. Talking of stocks, this is really interesting, actually. I find this fascinating. But moving back to the US, one top 10 US stock I didn't recognise was Fastenal, Fastenal. Yeah, yes. Fastenal. What is that? What does it do? And what do you like about it?
Okay, that's a fantastic little mid-cap US company. Their business is industrial supply, industrial distribution. So if you're running any kind of plant or manufacturing operation, engineering operation in the US, you have a sort of insatiable demand for nuts, bolts, fasteners. That's where the name comes from. Safety masks, blades for saws, all kinds of different things. And Fastenal is this great company set up some years ago, just serve that need, to be experts in that need, sort of always in stock, always ready, same day delivery, a whole bunch of things. Their motto is growth through customer service. So their philosophy is, if we just do a fantastic job of serving our customers, help them manage their inventory, everything's always available, get up in the middle of the night and deliver the part if that's what it needs to keep the production going, then they'll take share. And they've got a great history of taking market share through getting into new categories, opening up new locations and so forth. So it very much fits in that kind of long duration, compounding, the kind of 10% a year growth that Saints looks for. And as you say, like not a name that's widely known, but a great business and a great track record, which we think will continue into the future. Interesting,
thank you. Well, in Europe, sort of same trick again for me, really. But there's Partners, Swiss private equity group. I'm a little bit more familiar with that. It runs an investment company in the UK. But I would have thought it's not maybe the most well-known income stock. What's the story there? What do you like about Partners Group?
Yeah, again, I guess it all starts with the kind of way the company is run and it's set up. So they are one of the lesson. There's some of the people in the private equity space who shout and wave their hands a lot, and barbarians of the cake, that stuff. There's another section of the market who would describe themselves as quiet business builders, who rather than deal makers, who own a variety of private companies and try to allocate capital into private businesses. And they've got a terrific track record over the years of finding, particularly starting in Europe, which is where they started out, but now I was visiting them last week in the States, buying these businesses and then giving clients exposure to private equity assets. And they've done a great job of finding ways to kind of structure that as well, so that lots of people can participate in that, and smaller shareholders, and bespoke solutions for clients. So our philosophy or our thought around that one is that that's an asset class that's likely to continue to see good inflows for many years to come, generating good returns. And Partners is a very well run asset manager within that space. You can invest in it actually as a sort of listed equity in a business. And so we're expecting good earnings growth, good dividend growth from that business again for the next several years. Okay.
Well, switching back to the dividend, if I may, obviously Saints has grown the payout for 50 years and has that preference or policy of paying from natural income. But would the trust, I know it's a board decision, but would the trust ever consider paying dividends from capital reserves, so that could enable you to buy more low yielding growth stocks? That's the argument anyway.
I see, yes. Saints can. Within the investment structure, it certainly can, if that's what it chooses to do, pay income out of capital reserves. It's not a philosophy of how we do it, though. We look for that natural backing of income. Because of the various benefits that come with that. It's generating income out of capital is fine when capital is growing. When it's declining, it feels quite uncomfortable for shareholders often. So, but just a different philosophy. I'd say with, you're sort of saying so that we could buy more lower yielding companies. I think for some of those names, so let's take NVIDIA as an example, it's not that Saints can't invest in those. It's more about the fit of what is appropriate for our shareholders. So if a business is really deeply cyclical with ups and downs, and there's, or if the fact that it's, very high expectations, then we'll tend to shy away from that and find more sort of stability, if you like, and resilience in the business model. That's probably what prevents us from going for some of those lower yielders rather than the way that Saints is set up. We invest in Apple and Microsoft and Intuit, all companies with a yield below 1%, because we recognize that the growth in that income over time should be really, really strong. And they're also very resilient businesses. So it's really that drives it rather than the philosophy around natural income.
Okay. Well, thanks, James. We've had quite a few questions come in around the dividend and income, so perhaps we'll move to those. Start with this one. You've very much touched on it just now, but is there a dividend requirement for a company to make it into the portfolio, or could you buy a company with no dividend at all?
Yes, we want them to pay dividends, or we want to have a very high likelihood that dividends will start to be paid. So we bought Apple, this is in 2012, we bought Apple before it started paying a dividend, but we were highly confident it was about to start paying a dividend from our research and talking to them and so forth. So it either has to pay one, or we're pretty sure it's about to generate that income. So that's that one. In terms of the kind of requirement, we don't have a requirement like, it has to have at least an X% yield. I think that's where income investing can get a bit dangerous, because if you're taking the long-term view, the starting yield is, it's a factor in the equation, but it's also the growth of that income over time, and how resilient is that income going to be in stress periods? Because typically for our shareholders, for income consuming shareholders, it's not helpful if in stress periods, and I'm talking about, like 2009, 2020, whatever it is, if the income drops sharply away. So the resilience of that income, of the underlying investment is important, as well as the growth rate. And I would say that for Saints, we prioritize the growth and the resilience more than we do the starting yield. it's better to own a kind of a Microsoft, which was a low yield but fantastic growth over time, fantastic capital growth, and very resilient. As a shareholder, you've been infinitely better off in that, even as an income investor, than in, I don't know, a flaky oil company which cuts its dividend all the time, and it's got a 4% yield yesterday, but now it's a 1% yield. So we're prepared to invest right down the yield spectrum.
Okay, thank you. And similarly, another question on the dividend: do you have a compound annual growth rate for the dividend increases that come through?
Yes. So I'll give you a few statistics. So since 1938, so this is the last time that Saints was forced to cut its dividend, was in 1938. Since then, if you look back, the compound annual growth rate to 2023 was about 3% above inflation, above UK inflation, so 3% real growth. And again, if you look back to 2003, which is when the management was transferred to Baillie Gifford, again, since 2003, the compound annual growth rate in Saints dividend has been UK inflation, but so basically UK inflation has been about 2, and Saints dividend has grown around 5 since then. And so we're hopeful. We can't sort of promise it, but we are definitely hopeful that going forward, again, we can continue to deliver that real growth, above inflation growth in the income stream. I can't tell you what it will be in any particular year. In 2021, I think it was 11%, but then inflation was 9% in the UK. So it goes up and down in individual years and currency, but over the long term, our aspiration is to grow the dividend materially ahead of UK inflation.
Okay, thank you. I've got one more question on the dividend. Don't know if you recognise these figures, but this is the question. Is the falling income yield a worry, as it's gone from just over 4%, 4.09% in 2015, to 2.64% last year, according to a platform that one of the viewers is looking at?
Yes. Okay. So what's happening there? The income is not being reduced. The income has grown every year since then. What's happening is that the capital value is growing even faster. The share price is going up even faster than the income is growing, and that's been a phenomenon across equity markets. If you go back to that point in time, equity markets were quite depressed, and generally people were, yields were higher across most asset classes. And what's happened over that period of time is that, Saints being no exception, is that there's been a sort of re-rating of equities, and that's led the starting yield to fall, even though the dividend has been going up because the capital has been growing faster. So I wouldn't say it's a concern for us. I would just say that the environment that we're in today and the options that are available to investors mean that starting yields are a bit lower today than they were back in that period of time.
Okay. Well, that's the dividend, and that feeds into the total returns. We've got a question about performance. Long-term performance of the trust is strong, but we've got a viewer here saying past 3 years it's been a bit more stagnant, and just wondering why. Previously apparently you flagged that with falling interest rates, borrowing costs coming down, that would be a positive. So a viewer's asking, what happened there? Why didn't that come through to returns?
Yeah, good question. Essentially, what's happened is that you referred to it earlier, Gavin, because we're quite a balanced approach across geographically. The market is very heavily exposed to the US, and the US market has re-rated to historic highs, really been strong. Partly, in recent 12, 18 months, it's been the AI excitement, but also some deep cyclicals, some kind of like troubled companies where, thank goodness interest rates are being cut. Maybe it doesn't look so bad. So those have done quite well as well, again, in a US context. So although the absolute growth and total returns of Saints have been quite strong over that period, they have lagged the broader equity market because the equity market's been turbocharged by the US market going up to whatever PE it's on now, and by some cyclicals bouncing. I think we understand that. I think again, it's about. I guess it comes back to this point about balance and resilience. In these kind of very excited periods, Saints will probably tend to lag a bit. It won't do as well. On the flip side of that, we hope that when things look tougher or when there's less exuberance, then Saints won't do so quite so badly either. But that's essentially why the performance the past few years has lagged behind the index.
So, what can you say to suggest that get the trust back in front of the benchmark?
I think if over the long term, it's about sticking to our knitting and what we're doing. It's about finding those really resilient long-term compounders. So let me explain the plot another way. We look for really attractive rates of long-term growth. And for us, that means somewhere around 10% a year of the underlying equities. We want them to deliver earnings growth of around 10% a year. If they do that, and if we correctly identify those, then that should be, over the long term, that should be much stronger than the market. Historically, the market's probably done more like 5% nominal growth of earnings growth. So if we keep on doing that, then over the long term, we believe Saints will outperform that benchmark. There are going to be shorter time periods, though, and I'm not talking like short as in days, even periods, as you've seen in the past 12 to 18 months, where the market's definitely doing better or it's doing worse. We've seen that many times. So I think for us, we're not going to try and chase the market or replicate the market returns. Shareholders can do that themselves easily any way they want. I think it's about us sticking to our knitting of those great long-term compounders and finding the Apples, the Microsofts, the Novo Nordisks, the Fastenals, the L'Oreals, and all those other things that we have. If we keep doing that, then over the long term, we think that the trust should be back in front.
Okay. Good. And leading on from that, a viewer is asking or noting there are multiple technology enablers for trends, but she's interested to know, what are you doing in the portfolio for quantum computing or cyber security, for example? Ooh. Any of those ring any?
Question. Quantum computing, no. It is quite difficult. It's one of those things that it's very promising, but the economics of it and making that work and building a good business with an enduring edge has been much more challenging. So we've not yet found or seen anything there. That may happen. I would suspect that when that does come through, our holding in TSMC, I suspect, would be a big beneficiary of that as the kind of the world's chip manufacturer and the cutting edge, leading edge nodes and processes. But specifically on that one, no, not at this point in time. On cybersecurity, yes. So I think two things that we've recognized both in Microsoft, but also with our holding in Cisco, which is kind of network equipment, is that increasingly the cybersecurity piece is a very important part of what customers are buying. And those two companies have demonstrated that they've got really good, strong offerings there. So they're a bit more broad line, so they're not as niche as, let's say, a Cloudflare or CrowdStrike or some businesses that are purely built on cybersecurity. But that is a positive driver and a tailwind for those two businesses as well. So there is some exposure to that within the Saints portfolio.
Okay, thank you. Well, we've talked quite a lot about companies that you've bought, but we've got a question here about, interested in the companies you've sold or divested. Yeah, can you discuss a couple of companies that you bought into, but then since decided to divest from? And just talk a bit about the process, the diligence around those decisions.
Yes, absolutely. So one that we sold 4 or 5 months ago was Kering, the luxury goods manufacturer that owns brands like Gucci. We invested in that one in 2016, and over the piece, it was a good, successful investment for us, made good returns, paid good dividends, but we sold it, sort of 4 or 5 months ago. And what really happened there, we're always thinking about that long-term growth case being on track. The company took a strategic pivot going back 12 or 15 months to a new strategy, which in our view had a much lower chance of continuing their growth rate, effectively trying to move the brands up markets to higher price points, and doing a variety of things which they can work, but oh my goodness, they're hard. The probability of success and growth was very, very, in our view, was low. We engaged with them on that. We talked to the CEO and the family, shareholder behind it, talked to people, did research around it, wanted to make sure we weren't rushing in and just judging them too harshly. I mean, they'd earned a lot of credit from the fantastic record that they had over the years, but ultimately decided that we would exit that one and remove it from the portfolio because it just wasn't fitting. Over the piece, still a very successful investment for us, but going back to 2016, but just didn't fit anymore. We couldn't really believe in that long-term growth. And I would say, if you're owning 60 stocks, there should be kind of some competition, right? If you want to own 60 really fantastic businesses, which you have conviction in the long-term growth, and it just wasn't making the cut for us anymore. And so we divested. And another one I point to would be GlaxoSmithKline, where we had hoped several years ago, this is going back 2017, I think we invested. And again, actually, over the piece, it actually turned out to be a good investment, but we decided from here, no. It was one where we had hoped that there would be more of a rejuvenation of their research and development pipeline of new drugs under some new people they brought in who had a fantastic track record. But ongoing monitoring of that, talking to former employees, competitors, etc., it just didn't really materialize. Some other aspects of the business did very well, which drove some share price growth and got good dividends, but ultimately decided from here for the next 10 years, this is not one of our 60 best companies in the world with great compounding outlook.
No, okay. Thank you. That is interesting. Going on a little bit more sort of macro perhaps, but given some of the recent larger currency movements in the portfolio, we've got an investor who's curious as whether you use traditional hedging to protect the portfolio from currency movements, or do you do something else? What do you do to
our approach is more the one of balance, of not having too much exposure to any one currency across the portfolio, and to be careful with currencies that are particularly volatile. So that comes back to that point about not chasing the index and putting 2/3 of our capital into the US. And then if the dollar weakens, as it has recently, then that's a real problem for an income investor, potentially. So it's that approach rather than hedging. Hedging is, I'd say, far more complicated than perhaps one hopes, because actually when you think about where the revenue exposure is, so for example, in Saint's portfolio, the revenue exposure to the US is a fair bit different from the actual listing exposure. So how much do you hedge and so forth? So again, rather than go down that route, we've taken the balanced approach. What that means is that the currency risk for the income, certainly in the portfolio, probably the biggest one is around sterling strengthening a lot against all other currencies, because we're UK based and we're investing mostly overseas, great companies overseas. And so sterling doesn't tend to be it's not hugely volatile. It's not like some currencies, but it does move up. And that's something that we've seen in the past 12 months, certainly, that sterling has appreciated against most currencies. And so that's been a bit of a headwind to our income growth this year. But again, a benefit of the investment trust structure is that with reserves and other levers we can pull, we can try to offset that to an extent in different ways. So I'd say from a currency perspective, a shorter answer would be we don't hedge, we have balance, and the investment trust structure gives us various tools to be able to deal with the sterling volatility in the portfolio.
Understood, I think. And talking of investment company tools, I've got a question about gearing, the borrowing that Scottish American uses. Someone's observing net gearing appears to be at 105%, so 5% geared, according to today's figures. Is that figure right, by the way? But where do you see that going in the next 2 to 3 years? Perhaps you could say a bit more about what the borrowing is used for.
Yes, totally. So total borrowings, these figures, I'll give these because these are a little bit easier to work with. So total borrowings of Saints are £95 million. And the total assets of the company are somewhere around 1.1 billion. So it's probably the gearing is probably a little bit closer to, on a sort of total debt to total assets basis, it's probably a little bit closer to 10% than 5%. But
that's what I thought. Yeah.
Yeah. So, but if you keep that 95 million in mind, that's helpful, because the websites are never quite clear what they're quoting, and it's all a bit. So we call it a prudent level of gearing, a modest level of gearing. It is an advantage of the investment trust structure to be able to borrow, and typically at a much lower rate. So Saint's borrowings are a touch under 3%, in total, and we can invest those in assets like the property, like the infrastructure, which generate a yield higher than that, and that generates a little bit of extra income for shareholders. So that's kind of our philosophy, to have that, take advantage of the investment trust structure, borrow cheap, and it's long term, by the way. That 3% is locked into 2048, 2050, something like that, and invest it in those other asset classes. But I think the key thing is that it's modest. We never want it to jeopardize shareholders' returns or feel uncomfortable for shareholders. We're cognizant that these are shareholders' savings, right? And we're entrusted with them to grow them, but also to take care of them. And so we don't ever want to do anything with gearing or anything else that is going to be troubling or worrying, or shareholders going to bed at night thinking, oh my goodness, I don't know what's going to go on. We want them to sort of have a good night's sleep. So it's a modest level of gearing, and that's how we use it.
Okay. Well, and on that note, then I just wondered if I could bring you back to the sort of views on prospects for the global economy or the US economy, because there's a lot of hopes for a soft landing. But I think in the results recently, you referred to the kind of euphoria around that. Are you skeptical? Are you concerned that the landing might be hard as the economy slows down?
It definitely could be, yeah. Economists have correctly predicted 17 of the last 4 recessions, right? So it's very hard to make these calls on the macro. I think as a manager, the best thing you can do is be prepared, so that if it's a hard landing, then we've got a really good portfolio where that'll be fine. Apple and Novo Nordisk are not going to be derailed by a hard US landing, really, and certainly not the long-term picture. So we've got to be prepared for that possibility. What I'd say I see in the portfolio is, this picture where the consumer who's on a lower income is definitely feeling under pressure at the moment, particularly in the US. And we can see that across a range of companies who cater to that consumer, who are saying, wow, our consumer is really feeling the pinch at the moment from the way that, yes, the interest rates have recently gone down a little bit, but that's really starting to bite and hurt in a lot of ways. And I think it's definitely possible that spreads to the wider economy. I've definitely seen that before. It starts with the more economically sensitive consumer, and people say, oh, it's probably just them. It's just the subprime mortgage folks who will suffer here. No, it often does spread. So we've got to be careful about that, and we are careful in the portfolio to make sure that we are not exposed to that possible strengthening. Is that a prediction that we're definitely going to have a hard landing? No, that's very difficult to call. But what I'm saying is that as managers, we are very cognizant that could happen, and we're careful that the portfolio would not be caught out in a nasty way by that. And shareholders can still sleep well at night. That's
good to hear. One more question on property. Someone would like to know, do you see the UK property portion of the portfolio as an important diversifier? What is the future for this? Is it going to remain a feature of Scottish American?
Yeah, it's helpful for that, particularly that sterling diversification of income. That's where it's quite helpful. And it's also helpful in that context of, well, we've got this ability to borrow at low rates locked in, and we can invest that in good long index-linked leases in the UK, in sterling, in the same currency. So it has a useful place in the portfolio for generating a bit of extra income. In the whole balance point, I think it's 8% of total assets. So it's not a big piece, but as part of that diversification, balance, sterling management, it's a helpful piece.
Okay. 2 more questions to finish off with, a little bit different. Outside of Baillie Gifford, who has influenced you in your job the most?
Oh gosh, there's a good question.
You could take that a couple of ways, but
a lot of different people. In the investment world, and investment is a field where you're not just focusing on investment. It's a kind of multidisciplinary pursuit, right? You've got to understand a lot of different business models and what you're investing in, and people and psychology of markets, and lots of different things, in my opinion, to have success over a long period of time. And so for me personally, there's a lot of different influences coming in there from different spheres, from people who've built great businesses. I'm a sort of avid reader of business biographies of successful businesses to understand how they've done it and their own account of it. For investment field, to replicate that in the portfolio, for example. but also of investors with fantastic long-term track records. And in fact, I've been very lucky. I've worked literally a few feet away from a number of people who've had fantastic long-term records here at Baillie Gifford. So that's been a huge influence on me as well, and in other fields as well. So I don't want to pick out any one individual, but there have been loads of people who've been incredibly helpful and influential in developing my thinking as a long-term investor.
Okay, well, last question then. Obviously, you read widely, but we've got a viewer here who's actually thinking of trying to break into investment management. So for that aspiring fund manager, what key skills or experiences would you recommend they have?
Curiosity. You've got to cultivate that idea of you're just endlessly interested and fascinated in why does it work that way? Will it always work that way? What could happen? What could throw that off? So things that developing or cultivating that or enabling you to think differently are very, very helpful, I think. And I guess ultimately, so here's the thing. I think it's about a passion for it. I think you've got to. It's a cyclical ride, right? There are times when people think that you're a hero, and there are times when they think you've completely lost the plot. And behaviorally and emotionally, as an investor, you have to be able to ride those periods out and be able to get through them. And I think one of the biggest helps there is have you got that passion? Do you sort of you can't help yourself, but you've got to look at businesses and think about how they're going to evolve and what they're doing. And you're the kind of boring person. You're stood in the supermarket aisle and you're comparing why are they marketing in that way? Why is the box? You got that. You can't help yourself kind of thing. I think that's really helpful for the kind of long-term behavioral piece. That kind of passion for it as well, I'd say, is certainly a big thing we look for here. Is curiosity, being passionate about it, kind of almost would be doing it in your sleep kind of thing. Those are really helpful prerequisites, I would say. Okay, well, thank you very much, James, for sharing your passion. And I'm afraid that's all we've got time for. But thank you very much for being with us. I hope you've enjoyed today's show. We've more sessions like this coming up, so do keep an eye out for those if you found today useful. But in the meantime, from Baillie Gifford and Citywire, thanks very much and enjoy the rest of your day.